Have you ever seen a business unit look incredibly profitable, only to discover later that it was absorbing less expenses than what it should have? Or the opposite, sometimes a business line appears very unprofitable, but in reality is carrying costs that it shouldn't be there for them. This happens more often than people realize. And that's why strategic expense allocation is one of the most important and misunderstood topics in insurance. Hello everyone, this is Diego. Welcome back to the channel. And here we're gonna explore and discuss insurance finance, FP&A, capital allocation, and strategic decision making, okay? So sit down, grab your cup of tea, and here we go. In the previous videos, we talked about capital management, reinsurance, and IFRS 17. Today, we are focusing on something that impacts every insurance company: how expenses are allocated and why getting it wrong can lead to poor business decisions. To kick things off, why expense allocation matters. Let's start with a simple question. Let's frame it that way. How do you know whether a business line is truly profitable? Most people immediately think about premiums, claims, investment income. They're not wrong, but expenses are equally important. And in insurance, many expenses are shared across multiple business units. Think about finance, technology, risk management, compliance, actuarial support, human resources. These costs support the entire organization, correct? So the challenge becomes, how should they be allocated? How these costs should be allocated? Because the answer can significantly change reported profitability. Now, the danger of bad allocation, when things fall off. This is where the problems begin, really. And when allocation methodologies are poorly designed, they can distort reality. Imagine two business units, just an exercise here. One appears highly profitable and the other appears barely profitable. But after reviewing the allocation model, you discover that large corporate costs were assigned disproportionately to one of the business units. Suddenly, the profitability becomes something very different. And if management uses inaccurate information, they may invest in wrong areas, underinvest in strong businesses, misjudge performance, maybe make poor strategic decisions, right? This is why expense allocations isn't just an accounting exercise. It's a decision-making tool. What good allocation looks like? That's a good question, right? Strong finance teams focus on allocation drivers that reflect economic reality. For example, technology costs might be allocated based on system usage. Customer service expenses may follow policy volumes. Claim support functions may align with claims activity themselves. The goal isn't perfection. The goal is fairness and decision usefulness, okay? Because at the end of the day, expense allocation should help management understand how resources are being consumed. Not simply spread out, just like spreading costs for the sake of spreading them. That's not the end goal here. Now, the FP&A perspective. This is where FP&A adds enormous value. The role of finance isn't just to allocate expenses. It's to challenge whether allocations make sense. Good FP&A professionals would ask, does this allocation reflect actual consumption? Is management receiving meaningful insights? Are we influencing behavior unintentionally? Could this methodology distort decision making? Because the wrong allocation model can create the wrong incentives, and incentives drive behavior. Okay? Does that make sense? Now, as I like to do, a real world example. Imagine a commercial insurance portfolio that appears less profitable than a personal lines portfolio. Management might decide to reduce investment in commercial business, but what if the difference is largely driven by a legacy allocation methodology? Without understanding the underlying drivers, leadership could make the wrong strategic choice. That's why transparency really matters. Okay? To close things off now, every allocation may not sound exciting. Like expense allocation at the end of the day is something boring, let's be honest. But it sits at the heart of strategic decision making because every capital allocation decision, profitability assessment, and business case depends on understanding costs correctly. The best finance teams don't just allocate expenses for the sake of doing this. They help organizations understand where true value is being created. In the next video, we will explore one of the most important links between underwriting and capital. Why some insurance policies consume far more capital than others. If you're enjoying the series, subscribe and follow along. And let me know in the comments, how does your organization allocate shared costs today? I'll see you in the next one. Thank you for watching and see you. Bye.